Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are scrubbing in. We're cracking open Intuitive Surgical, ticker ISRG, the company that basically invented modern robotic surgery.
And I'm Lana Chen. Intuitive is one of those rare companies where when someone says robotic surgery, there's really only one name that comes to mind. They own about 60% of the entire robotic surgery market globally. That's not a position you stumble into.
No, it is not. And the timing here is perfect. Da Vinci 5 is ramping fast, they just got cardiac clearance, and earnings drop April 21st. So buckle up. Let's give you everything you need to know. So here's the story. Intuitive Surgical was founded in 1995 in Sunnyvale, California. They went public on June 13, 2000, at a split-adjusted price of about $2 a share. Today, we're looking at north of $450. The company was led for years by Gary Guthart, who recently transitioned to chairman. Dave Rosa stepped in as CEO in July 2025.
And the core product is the Da Vinci surgical system. These are large robotic platforms that sit in operating rooms and give surgeons enhanced precision, better visualization, and smaller incisions for patients. Think of it as giving a surgeon superhuman steadiness and a magnified 3D view inside the body.
The business model is brilliant, actually. Selling the system is just the entry point. Each procedure requires single-use instruments and accessories. That's the razor and blade model. 85% of Intuitive's revenue is recurring. You sell one system, and the revenue keeps flowing with every surgery.
They also have the Ion platform, which is a robotic bronchoscopy system for lung biopsies. Over 900 systems deployed globally. And they've recently added AI-enhanced navigation capabilities that got FDA clearance. It's a smaller piece of the business today, but the growth rate, 44% procedure growth for Ion in 2025, tells you where it's heading.
17,000 employees operating out of Sunnyvale, and they've served over 20 million patients worldwide with Da Vinci procedures. 20 million. That installed base of over 10,000 systems is really the moat around this castle.
Let's talk about that moat for a second. Surgeons train on Da Vinci starting in residency. Data shows that surgeons who complete 13 cases in their first 90 days have a 90% plus continued usage rate. That's not brand loyalty, that's muscle memory. Hospitals have millions invested in the hardware. You don't just swap that out for a competitor overnight.
All right, Lana, take us through the numbers. This is your domain.
Happy to. Let's start with valuation, because this is where Intuitive always gets interesting. The stock trades at $452.07. Market cap is approximately $160.9 billion. The trailing PE ratio is 60.4 times earnings. Forward PE comes in at 45.2 times. Price to book is 10.3 times, and the EV to EBITDA ratio is 48.9 times.
So it's not cheap at all.
No, and it never really has been. The PEG ratio is around 2.8 times. The 52-week high was $603.88, and the 52-week low was $425 even. So we're sitting closer to the low end of that range right now, about 25% off the highs.
That's actually notable. You don't often see a company this dominant trading that far off its highs.
Right? Now, income and growth. Fiscal year 2025 revenue came in at $10.065 billion, crossing that $10 billion threshold for the first time. Year-over-year revenue growth was 20.5%. Looking at the quarterly trend, Q4 2025 was $2.87 billion, Q3 was $2.51 billion, Q2 was $2.44 billion, and Q1 was $2.23 billion. That's consistent acceleration through the year.
$10 billion from selling surgical robots and the instruments that go with them. That is a monster business.
Earnings per share on a pro forma basis came in at $7.87 for fiscal 2025. That's 22.6% growth year over year. This was their third consecutive year of over 20% EPS growth. Margins tell a mixed story, though. Gross margin was 66%, which is down from 69.1% in 2024. Operating margin was 29.3%. Net margin was 28.4%.
What happened to the gross margin?
Tariff headwinds accounted for about 70 basis points of the decline, and there were some additional manufacturing costs tied to the Da Vinci 5 ramp. Management guided for 67 to 68% gross margin in fiscal 2026, which includes an additional 120 basis points of tariff impact. So they're managing it, but it's a real headwind. Now, the balance sheet, and this is where Intuitive really shines. Free cash flow for fiscal 2025 was $2.5 billion, up 91% year over year. FCF yield is approximately 1.55%. And here's the headline: Intuitive is essentially debt-free. Total debt is just $170 million. Net cash position is $5.76 billion. Cash on hand is $5.93 billion. The current ratio is 4.73, which is exceptional liquidity. Debt to EBITDA is effectively zero.
Debt-free with almost $6 billion in cash. That is a fortress balance sheet.
It is. Total assets are $20.5 billion. Book value per share is $44.01. And just to confirm, Intuitive does not pay a dividend. They retain everything for reinvestment and growth. Overall, Intuitive Surgical's financial health is strong. A debt-free balance sheet, nearly $6 billion in cash, accelerating free cash flow, and consistent 20+% earnings growth make this one of the healthiest companies in the S&P 500.
All right, let's talk about what the street thinks. 44 analysts cover this stock. The consensus is a moderate buy, 24 buys, 9 holds, and 2 sells. The median 12-month price target is $615.50, which implies about 36.2% upside from where we sit today.
And the range is wide. The low target is $440, which is basically flat from here. The high target is $750. That spread tells you there's genuine debate about the valuation.
Goldman Sachs has been particularly bullish. They've recommended buying call options ahead of earnings, citing implied returns exceeding 50% if shares hit analyst targets. Evercore's Vijay Kumar has an outperform rating with a $625 target, maintaining conviction on the Da Vinci 5 ramp.
On the insider front, it's been mostly selling. Over the last 90 days, insiders sold 32,943 shares worth about $17.3 million. Notable sellers include Chief Medical Officer Miriam Curet at $487 per share and SVP Mark Brosius across 3 transactions. All sales were under Rule 10b5-1 pre-planned trading plans, so these were scheduled, not reactive. No insider buys in that period. Short interest is relatively low at 1.79%.
And last quarter's results were strong. Q4 2025 revenue came in at $2.87 billion versus the estimate of $2.75 billion, a 4.4% beat. Pro forma EPS was $2.53 versus the estimate of $2.26, nearly a 12% surprise. They've beaten estimates 4 quarters in a row now.
The guidance was the conversation piece, though. Management guided for 13 to 15% worldwide Da Vinci procedure growth in 2026, which is a step down from 2025's 18%. That deceleration concerns some analysts.
All right, bull and bear time. I'll take the bull case. Catalyst number 1, Da Vinci 5 is on a tear. They placed 870 units in 2025, up 140% from 362 the year before. Hospitals are upgrading from the C platform, and the new system has over 150 design innovations, including force feedback technology. Preclinical data shows surgeons exert 43% less tissue force with force feedback engaged.
On the bear side, that premium valuation is the elephant in the room. At 60 times trailing earnings and 45 times forward, you're paying for perfection. Any stumble on procedure growth or margins could trigger a meaningful pullback. We've already seen the stock drop 25% from its highs.
Catalyst number 2, cardiac. The FDA cleared Da Vinci 5 for cardiac procedures, including mitral valve repair and internal mammary artery mobilization. That's an estimated 160,000 new procedures per year in the addressable market. That is a significant expansion of what this platform can do.
Competition is the second bear argument. Medtronic's Hugo system received FDA clearance for urology in December 2025 and is gaining traction internationally with a lower price point. Johnson & Johnson's Ottava platform has a de novo FDA submission for general surgery. If approved, it could reach the market by 2027 or 2028. J&J has commercial infrastructure in over 130 countries.
Catalyst 3, international growth. Procedures outside the US now account for 35% of total volume, growing at 23% year over year. Asia is up 24%, Europe 21%, and rest of world 27%. There's still enormous white space internationally.
But China specifically is a risk. Provincial tenders are giving weight to local suppliers, which pressures margins in what should be Intuitive's second largest growth market. They're responding with a local manufacturing joint venture through Into Fosun, but that margin compression is real.
And Catalyst 4, the Ion platform, 900 plus systems installed, 44% procedure growth, and new AI-powered navigation just cleared by the FDA. The broader U.S. launch is planned for 2026. Lung biopsy is a sizable market that diversifies Intuitive beyond general surgery.
The fifth risk I'd flag is macro sensitivity. Hospital capital expenditure budgets fluctuate with the economy. Management specifically called out potential ACA premium subsidy changes and Medicaid funding uncertainty that could affect 2026. Elective procedure volumes can drop in a recession.
Fair points all around. Let's do the peer comparison. How does Intuitive stack up against the big medtech names?
Medtronic trades at a PE of 24.2 times with revenue growth of 5.5% and an operating margin around 19.5%. Market cap approximately $110 billion. Stryker has a PE of 46.6 times, revenue growth of 9%, operating margin of 22%, and a market cap of about $145 billion. Abbott Labs trades at 30.2 times earnings with 5.7% revenue growth, an 18% operating margin, and a $200 billion market cap.
So Intuitive is the most expensive of the bunch by a wide margin, but also has the fastest growth and the highest margins.
Exactly. You're paying a premium, but you're getting premium growth. 20% revenue growth and a 29% operating margin versus single-digit growth and sub-20 margins for the peers. The question is whether that gap justifies a PE that's more than double most of them.
The bottom line on Intuitive Surgical. This is a dominant franchise with a razor and blade business model that generates enormous recurring revenue, a fortress balance sheet, and accelerating product innovation through Da Vinci 5 and Ion. The valuation is steep, but the growth story is real.
The single most important number to watch is the Q1 2026 procedure growth rate when earnings hit on April 21st. If management can demonstrate that 13 to 15% guidance is conservative, especially with Da Vinci 5 and cardiac contributing, this stock likely recloses the gap to those analyst targets. If growth disappoints, the premium unwinds fast.
We'll close with this quote. The best technology is invisible. It simply lets great people do greater work.
I like that. For a company that puts 10,000 robotic systems in operating rooms around the world, their real product is the surgeon's confidence.
Well said. Before we go, head over to chargedalpha.com for full show notes, charts, and the complete financial breakdown on Intuitive Surgical. You can find every episode, every stock, and our full S&P 500 encyclopedia, growing one episode at a time.
Subscribe wherever you listen so you never miss a deep dive.
That's our deep dive on Intuitive Surgical, ticker ISRG, episode 93 of Charged Alpha.
The S&P 500 Stock Encyclopedia. We build the book. You make the call.
This podcast is for informational and educational purposes only. It does not constitute investment advice, a recommendation, or a solicitation to buy or sell any security. All data presented is sourced from publicly available information believed to be reliable as of the recording date, but is not guaranteed for accuracy or completeness.
Past performance does not guarantee future results. Investing involves risk, including the possible loss of principal. Always do your own research and consult a qualified financial advisor before making any investment decisions.
Portions of this episode's research, script, and production were assisted by artificial intelligence tools. All AI-generated content has been reviewed for accuracy, but listeners should independently verify any data before making financial decisions.
Charged Alpha and its hosts have no positions in any securities discussed and receive no compensation from any companies featured. This is Charged Alpha, the S&P 500 Stock Encyclopedia.
Ooh. we do. That ticker tape starts dancing fast, a bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.